Today's number is 446. That's the amount of bankruptcies we've seen in America so far in 2025. And it means we're on track to be worse than 2020 already. So, what does this mean for the economy and indeed the stock market and markets around the world? Well, one thing's for sure, we may be starting to see a lack of momentum. And with retail already getting liquidated over the past 48 hours, it's clear to see that there are traps being set by Wall Street. So what could the biggest hedge in the world be telling us about the market moves into August, and what are the data and stats suggesting happens next? Well, in today's video, we'll break down everything that you need to know, including whether crypto is about to fall even more. Stocks, commodities, and cryptos. Guys, let's get right into it together right now. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we'll be taking a look at the latest macro, the bankruptcy filings that definitely are on the rise, and of course, the last 21 times we saw similar market conditions. Did we enter into a kangaroo market, pullback, or indeed just continued on with a bull run? That and more coming up in today's show, but we'll kick things off here with US bankruptcy filings because they are on the rise and we're getting back to 2020 levels. In fact, we've already surpassed them according to this time in the year, and it makes us question, is there something seriously wrong with the US economy? Well, of course, this is a worrying statistic by itself, and if you break it all the way back down to 2010, you can see that we're on track to be one of the worst years, if not possibly even the worst year since that period of time. So does that mean a recession is imminent? Well, it certainly shows you that there is a huge discrepancy between the winners and the losers in the markets. We already know this due to a concentrated market driven by AI. But we also know that the share of the Russell 2000 companies with negative earnings continues to actually rise. Now, this is a result back from 2024, but we're looking at possibly new all-time highs here when it comes to over 45% potentially of the Russell 2000 stocks actually not making any money. And that is a little bit of a problem if that does continue, because of course, eventually somebody has to be making money for the stock to be worth anything. Now, where the bankruptcies are happening is also a concern. We're seeing it in both the industrial side, which is not exactly great for jobs in the movement forward, and maybe even more worryingly, it's coming in from consumer discretionary. Now, if you're already aware, 1/3 of the US economy is made up by the American consumer. And you can actually track the American consumer with a really handy code, which is consumer discretionary versus consumer staples. And we often look at this on charts to define whether the market should be risk on or risk off. Now, that's started to flounder a little bit in recent weeks, but realistically, it's still not showing signs of absolute collapse just yet. But if we see this flowing through into the stock market and indeed flowing through into the bonds market and debt markets, then of course it is that canary, that siren that tells us to maybe start to pay attention. Now, why is this happening? Well, of course, we've seen an effective tariff rate at the time of this recording at around 17% across the board. And of course, we've also seen American companies now announcing that they're passing on more and more of these tariff costs. Specifically, we saw Walmart saying fruit and veggies are going up. And at the same time, we saw the Goldman Sachs report, which we shared here on the channel. Make sure to subscribe, by the way, if you enjoy this type of content. And what we found was that 67-ish% of tariffs are expected to be passed on to the American consumer, and the rest will be absorbed by the distributors or, of course, the producers themselves. Now, that's at least the expectation, but we haven't seen that come through, and it's not expected to really hit the US economy until around October of this year. So with US unemployment starting to rise up, and with youth unemployment in particular looking really, really bad, what is going to happen next? Take a look here at the 20 to 24-year-old graduates starting to rise back up again. And interestingly, this is happening at a point when you wouldn't really expect it. Generally, you see these types of rises happen after a crash or during a recession themselves. But we're seeing it before any of those things have occurred. So what are the benefits? What kind of things could happen to the market to take us higher? Well, obviously, AI could continue to make a lot of money for companies and therefore, lead into upgrades across the board, which is what we've been seeing. We could see the Fed potentially do rate cuts, which is what the market's going to be looking for. But if we see the Fed not rate cut, maybe it's getting too late because, of course, these numbers are starting to skyrocket. And the latest jobs numbers coming out from the non-farm payrolls, which will happen, of course, early September, is going to be a blockbuster event. So we'll, of course, be tracking that very closely. Let's now take a look at US equity call options. According to Citadel, the latest data suggests that there are more calls in the market than ever before, and that, of course, retail owns a lot of them. Now, why is this? Well, retail, of course, is getting euphoric on certain stocks. And we've already seen an unwind of PLTR, which seems to have been caused by a bunch of hedge funds also having an aggressive attack on shorting a stock that they believe is highly overvalued. But really, the main storyline that we've been going with here on the channel is that this is all part of a rotation. So what we've seen is technology stocks have outperformed. We had like 30% of all the stocks making up pretty much most of the gains. And indeed, top 10 stocks, which we've been covering, made up 80% of the gains since Liberation Day. Now, Optum has got some interesting data here. According to them, 6 days down on the triple Qs is a very interesting time. 21 times before this has happened. And here are some stats that will surprise you. Only down 3% over 6 days has happened 21 times. And it will on average fall another 1.7% over the next few weeks. Now, of course, it could fall a lot more than that, or less even. But it takes 80 days to regain the 3%. Now, I thought that was the interesting stat. I was like, wow. So I obviously did reshare their post over on our X, following the links in the description down below. But how about that, hey? It takes not only ages to drop the rest, but it also takes ages to regain. 80 days just to regain that percentage. What does that tell us? We could be in a pit or kangaroo style market. And as you guys know, this fits very well into the narrative that we've been going with, which is, of course, a rotational shift from street and into value and potentially healthcare and those types of other areas that have underperformed. And at the same time, a liquidation potentially of some tech stocks, as some have run pretty well. Take a look here at the overall year-to-date return of healthcare versus the S&P 500, and you're going to see the worst performance, I think, for a very long time for this particular section of the market. Now, we all know why, but at the same time, certain rumblings have started to pick up certain stocks here. United Health being famously bought by Buffett during his filings recently, and obviously has ramped off that a little bit. And some of these other ones as well, starting to show some dark pool activity. So could it be that healthcare is on the improve, even though it's climbing the wall of worry in terms of the news? Well, a lot of this is probably going to come back down to what happens maybe at Jackson Hole or the next jobs number. Now, we know that Jackson Hole is a fairly important event. You can see this chart here, courtesy of Mike Zaccardi, shows that basically during Powell's speeches, we do tend to see a little bit of a move on the 2-year yield in terms of basis point moves, but sometimes it triggers a larger event. And some of those events have actually led into relatively large sell-offs, or, especially I think around 2 years ago. Now, I'm not necessarily scared of the Jackson Hole event, but I think we need to be aware of what's happening underneath the hood. And we also need to be aware of, if this market continues to rally, that it's probably doing so on false pretenses. Now, it's not that these companies aren't great, but we do know that we are in incredibly overvalued periods. So we always follow the trend, we always follow the flows, and that's why we've kind of started to figure out a little while ago now that we started to see rotational flows from the street. And in fact, now the best returners over the last month have actually not been what you would think. They're more healthcare related and other stock related than they are semiconductors. According to Fundstrat, Tom Lee's latest macro research, you can see here, he believes that 7,000 is possible by the year end. And while that is a pretty epic number, in markets that go euphoric, anything is possible. I like to look at Wayne Whaley's data, and you can see here there's some great stuff coming in from the Kangaroo market, which does state that if you look at similar periods of time, while we do have, up, down, and all arounds, we do end up pretty positive over the October to November run. And this really falls well into both the crypto narrative that we've got going on right now and the stock market narrative of a post-election year. Some kind of kangaroo style, up, down, and all around into the end of the year makes sense when you're also looking at a bull market year 3, which is where we're currently at least if we believe we're still in a bull market. And of course, the bear trap narrative of crypto, which is that when you're in a crypto halving cycle, somewhere between 3 months to the end of the standard cycle run, you generally see what we call a bear trap. Now, a good bear trap on crypto will lose between 20 and 30%, which of course we have not seen just yet. But it does beg the question, will we see a bigger move on Bitcoin? If you have a look at the last two periods, you can see here a fairly large sell-off happening in 21 into 22. And then, of course, another decent one that happened here in 2017 during that period run. So we're around this point right now. Do we see something like this again? I asked you guys in the comments, and a lot of you said yes. And a lot of you said that people are not euphoric enough. And I think you're starting to get the idea, guys. Well done to you. Because, yeah, it's all about euphoria. You may think because we're in this world of investing and trading and you guys are experts in the field that, of course, everyone's euphoric. But you've got to remember, you need everyone. The old adage of standing in the elevator. If someone's talking about altcoins, yeah, it's time to start thinking about getting out of that. And you know what would be even worse? If you went to an elevator and someone started saying, hey, I think PLTR is the best stock in the world and I'm going to buy all my money and sell my house. Now, that would be pretty worrying if that did happen. But the good news for at least now is that August is unlikely to be the absolute peak of the markets. It's only been a peak of one period over the last 30, 40 years. So realistically, it is unlikely to be the one. Actually, December is the worst. Have a look at that. 23 hits in December. That's pretty worrying. That doesn't mean you can take your eye off the prize, though. Of course, hopefully you subscribe to this channel and you enjoy the content, because we have seen this happen a few times before. 21, 99, 66, and that famous 1929 that too many people talk about. Now, why is this important? Well, we're up there with those types of valuations when you consider all sorts of valuations. I really like this one from Simon White from Bloomberg, and it's a pretty cool chart. And what it shows you is we're in the twilight zone. And I actually wrote something about this on my LinkedIn in terms of AI businesses, because we're following a very similar path to previous new technologies. So I wrote a little bit of a piece about that if you're interested. Links in the description down below as well to follow me there. Now let's have a look at the S&P. What's going on here? Well, the S&P 500 has been going in a series of higher highs and higher lows. So is it time to panic? The answer is quite simply no. We do not see panic signs. Advanced decline line has been pretty strong. Market has still been in an upward trend. We haven't even dropped to 6,200 or anything. But what we can start to see here is a significant kind of, I guess you would say almost thing that's been a pattern that's been happening, which is that each day, even if we come in green, it's ending red. So we're clearly seeing a little bit of selling coming through. Now that we've closed at this 63.75, which is like a minor support, it kind of also opens up negative gamma in the options market, which could get us to, as you guessed it, around 62.90. Now, 62.90, funnily enough, as you'll see here in the options market, is the number one put written level. So have a look here. We've got 62.90 for the 22nd, 25th, currently at 62.50. And remember, if we give up 62.90, the next stop, I think, is going to be about 6,200. And then if we give up 6,200, we're probably going towards a 6,000 or just underneath 6,000 level. These are all considered healthy pullback rotations. It's something similar to what happened in 2020 during actually the August, September, October period. You can go back and study that if you're interested. What about Tesla? 320 is the put wall. So it's holding that right now. It's kind of neutral, but the charts are just barely holding up towards the bulls. And of course, if it gives up that level, it could easily go to 300. And we'll look at that soon. And then, of course, comes Nvidia, which continues to struggle between 120 and 170 and 185. So again, the puts seem to be sitting around there. All right, guys. Well, let's take a look at the most important charts that are really defining this market. First up, of course, we have IGV, which is the software sector. And it's actually showing, as you would know, being a technical analyst as well, a head and shoulders style pattern. Now, it's technically broken below the neckline here. And although I wouldn't say, oh, wow, that's a massive short indicator, it does beg the question of whether we've seen a temporary high. Now, whenever you're looking at big rallies, and this, of course, was an epic rally, you can kind of see here you've got your lows, your highs, and you've got one of the fastest recoveries of all time. You're also putting pressure now on the weekly 20 already on this market. So first off, I guess you would say that you've got software companies showing some form of weakness, and that's certainly a worrying sign. Maybe more importantly, though, we need to look at RSP, which instantly tells us this is more of a rotational play because it's not as weak. And then, of course, we also need to look at equal weighted technology stocks to see whether across the board we're seeing a sell. Now, you guys know I also cover semiconductors as well, which is coming up to a heavy support. So what's clear is that if we give up some of these levels, it may actually define a run-of-the-mill style pullback that could get into those 6,000 style levels. Why? It's the right time of season. It also is the kind of period that you would expect kangaroos post-election, and the charts themselves are starting to show that flow. Most notably at the moment, what you may see here is every time this particular chart's coming down to these levels, it's finding strong rejections. And that's showing you that Wall Street is active, or at least someone's active of trying to buy the dip. Maybe it's not Wall Street, maybe it's retail. So if we then drop this level, you can kind of see how much more significant it is. So this will be one that we're covering very closely, along with, of course, our bonds indicator here to see whether it keeps spiking up. Because remember, only about a week or two ago, it started to show signs of a little bit of nastiness potentially on the horizon. From that point, though, we've just seen more of a sideways style stock market. And that's kind of the way it works. Sometimes it distributes, creates things like a head and shoulders pattern, and then starts to find weakness. Now, the biggest hedge in the world is not actually gold. It's technically the US dollar. And of course, we've started to see risk on with this. And it's another one of those head and shoulders pattern, this time the inverse. We first talked about this strength over here. We've then seen weakness. We've then seen potential here for a break up of the dollar. And that opens up the possibility that the dollar actually may go up to that 101.60 zone. Now, do remember, this is the most crowded trade, and the crowded trade was to the short side that we've seen. It was gold earlier this year, and that's done nothing since. But then it became the dollar. And as you guys know, oftentimes when you get that crowded, it begins to potentially look towards the other way at least, or it starts to coil pretty hard. And that's what we've seen with gold. So even with the strength in the dollar, gold hasn't given up yet. And that's because people are moving clearly from a risk on to maybe a slight risk off sentiment, going into value stocks, healthcare, other markets, other areas, while they unwind a little bit on the tech side. You can see here gold is stuck in a monstrous pennant, and eventually it's going to break and it's going to be significant. I'm hoping it breaks the upside because you guys know I've been bullish for years on that, but we haven't seen it just yet. Another one is, of course, silver. You can see here we've actually picked up over the last two sessions. You guys know I'm bullish on silver, ideally into 42.43 from a macro perspective. Obviously, make your own decisions on that, but so far that's been so good. Silver into Nvidia, bit of a weird combo, but anyway, let's have a look here at Nvidia. You can see again, it has given up the daily 20, which is kind of important, and it started to show again a little bit of weakness. And when you add semiconductors across the board into that, you can see here there's a lot of pressure on this downward side, but it is still in an upward trend until at least it breaks underneath here. And I think it's also important to note that even if it breaks under here, you're only losing the daily trend. You're not losing the weekly. You're not losing the monthly, the two most important ones. So the flow is still to the upside. It's just a question of, do they want to liquidate us, the retail traders that are maybe a little over levered? Tesla's back down to 320, which is a put wall. We'll see whether it can hold. You can see the trend line here as well. So it needs to find a bid, but hasn't been able to just yet. So it did get close to that 350. You can see here, which is that first core wall. Didn't break through to the 380. But yeah, we'll see whether it can find any support. And as we thought, the Chinese market doesn't really seem to care. It's just doing its own thing. And if you actually look at the composite market for China, it is ramping. So this is exactly what we would expect with the amount of liquidity being pumped in by the Chinese central bank to get ahead. Also, you've got to remember, they just had those, I think it was like the robot games or something. If you haven't seen the video, you might want to check it out. It's really weird. A bunch of robots from all over the place running around, having an athletics event, and it's almost creepy. Can anyone say Terminator? I think it's coming maybe sooner than you think, guys. What was it called? Skynet? It could be here soon. So anyway, for now, we have to make money in markets, but then Skynet will get us. Let's now have a look at the US 2K. What's going on there? We've got a tweezer. So again, showing signs of a totally different market. Even though most of these businesses don't make any money, you can see here there's actually a bit of a tweezer, signaling that maybe there's some buyers here in Russell compared to other things. And we've already seen this when we look at value funds. because value funds are not dropping much. Look at this. It's exactly what we've been talking about in terms of current rotation. And that doesn't mean that the value fund has to hold up, but what it's doing is it's at least holding up better than the S&P. And we'll do a special on this on the weekend, so stay tuned for that as well. Let's now have a look at the NASDAQ. The NASDAQ's dropped a pretty crappy trend line, but still there is one there. It's fallen underneath the daily 20, which has shown weakness, but again, it hasn't dropped a major support. So the trend is still a series of higher highs and higher lows. I'm not really that too worried about it yet or anything like this, but you've got to keep in mind that even if it goes down here, that's still a 5% pullback. If it goes down to where I would prefer it goes to, which it just makes sense in a standard pullback, about 10 for the NASDAQ would be better, but we'll see whether it does that or not. So this is going to be the question. If it falls underneath and rallies, that does open up that 10%. So a lot of questions may be answered very soon on some of these charts. Ethereum seems to be questionable. It's obviously strongest or one of the strongest in the crypto markets, but hasn't come back to what I would consider an exceptional demand yet. Although we did see that massive dark pool trade come through, and Bitcoin faces off on its biggest target. It's oversold now on some metrics, but it is pressuring that 112. And obviously, if it gives up 112, we're going to end up somewhere in this structure. And if you had to guess, of course, you're going to use volume profile, and you're going to go somewhere in this block here. So this block here makes the most amount of sense, about 105K, something like that. So what do you guys think? Do you think crypto is going to drop through 112? Or are we going to get this proper 20% style correction? Let's actually measure this out here so you guys can see what that would give us. So that would be about 15%. Still not even 20. 20 would actually have to get underneath or around 100. So that's going to be questionable. This weekend's trade is going to be big on Bitcoin as well because, and into the Jackson hole, because of course you can see all these breaks that could occur. And now we've made a lower low. So if we start to signal this type of strength, then that could be bringing day traders and momentum traders back in. So you can see there's two cases. The trend is still up on most of these markets, but we haven't seen a bid to get us back into the momentum flow. So there's more weakness that there is strength at this stage. Could Jerome change that? Well, of course, make sure to pay attention because he is speaking 10 a.m. Jackson Hole, and that is on Friday. And then we may get some more information about whether he's going to cut interest rates or not. And that's really the main question. Everyone's just speculating he will. But they're also speculating that maybe he'll say, oh, we're concerned about the PPI inflation, we're concerned about reinflation, and we're not going to do it. Now, if we don't do it, the market may chuck a hissy fit, and then all of a sudden we're seeing sells and some de-risking across the board. Guys, if you enjoyed today's video, then please remember to subscribe. Check out our course sales as well. We're launching a new one, Advanced Options, which is going to be awesome. So you can check that one out as well if you're interested in finding out more about put walls, call walls, those kind of things. And then, of course, follow us over on X, LinkedIn, and the other social medias. Thank you so much, guys. You have a fantastic day, and we'll see you in the next one. Bye for now.